All right, everyone. Welcome. Thanks for being here. In the next few minutes, we're going to dive into the numbers and trends that are really shaping the market. We're going to cut through all that noise and just look at the data to see what's actually going on under the hood of this economy.
So here's our game plan. We'll kick things off with a look at how the market's been doing. It's been strong. Then we'll uncover the big reason why, which has everything to do with a major policy shift from the Federal Reserve. From there, we'll see how that's rippling out into the broader economy and, of course, the housing sector, and we'll wrap up by looking at where the opportunities might be hiding. Sound good? Let's get into it.
First up, market performance. Despite a whole lot of uncertainty out there, the story of 2025 so far has really been one of surprising strength.
Just look at these numbers. It's been a very positive year across the board. The tech-heavy NASDAQ, it is leading the pack with an incredible 11.6% gain. The S&P 500 isn't far behind, and the Dow is also putting up some really solid returns. But, and this is a big but, that strong performance comes with a major catch. Our analysis, which basically weighs what companies are earning against what the market thinks they're worth, is flashing a pretty big warning sign. It looks like the market is roughly 40% overvalued right now.
So you might be asking, where is all that overvaluation coming from? Well, it's not spread out evenly, not at all. It is heavily concentrated in just a handful of those mega-cap, AI-driven tech companies. What this means is that the health of the broader market is actually a lot more modest than the headlines want you to believe.
And that leads us right into the single biggest story influencing all of these numbers, the Federal Reserve. They've made a major shift in their policy, and it's changing everything.
After what felt like an endless cycle of aggressive rate hikes, the Fed is finally singing a different tune. They hit the pause button back in July, and now pretty much everyone is expecting the first rate cut, 0.25 percentage point, to happen this month.
So why the big pivot? Well, it all comes down to one thing: inflation. The data is finally showing that all those previous hikes did their job. Inflation is cooling off, and the forecast now has core inflation falling toward that 3% mark by the end of the year. That gives the Fed the room they need to start easing up a bit.
And you got to remember, these rate cuts aren't just numbers on a screen, they have a real-world impact. We expect them to give a much-needed boost to the parts of our economy that are most sensitive to interest rates, especially things like manufacturing and, yes, housing.
Okay, so with the Fed changing its playbook, let's zoom out for a second and take the economy's pulse. What does its overall health look like right now?
The big headline number is a projected growth of around 1.5% this year. Now look, that's not exactly blockbuster growth, but it is steady. You hear that term soft landing all the time, right? Well, this is what it actually looks like: a gradual, controlled cooling instead of a sharp, painful recession.
But let's look under the hood of that 1.5%. If we dig into the manufacturing sector, the ISM index came in at 48.7. Now, any number below 50 signals that things are shrinking or contracting, so it's pretty clear that sector is still facing some significant headwinds.
But, and this is important, within that number, we're seeing the first little green shoots of a turnaround. For the first time since January, the new orders part of that index actually grew. That's a very encouraging sign that manufacturing might have already hit its bottom.
And while manufacturing is fighting its way back, what about the consumer? What about you? Well, you're still spending. Personal spending was up by 0.5% in July, and that's really being supported by strong wage growth, which is keeping most household finances in pretty solid shape.
All right, let's shift gears to a topic that I know hits close to home for so many of us: the housing market. It is still a challenging environment out there, but we are seeing some interesting developments.
So this is the big question, right? This is the one I get from everybody. Is it a good time to buy a home? And right now, the central issue, the thing that overshadows everything else, continues to be affordability.
And this number, wow, this one really puts that challenge into perspective. The combination of high home prices and high mortgage rates has pushed the average age of a first-time home buyer all the way up to 38 years old. So the housing market is really a story of challenges on one side and hope on the other. On one hand, you've got affordability as the main hurdle, and high construction costs have made builders a little less confident. But on the flip side, housing inventory, the number of homes for sale, is finally starting to improve, and that could offer some much-needed relief down the road. So, after looking at the markets, the Fed, the economy, and housing, let's try to put it all together. As an investor, as someone trying to build wealth, where might you look for potential opportunities in this kind of environment?
While all those giant tech stocks are grabbing the headlines, it might be worth looking somewhere else. Smaller U.S. companies, what we call small caps, have actually underperformed for about a decade. But because of that, their prices, their valuations, are now looking a lot more attractive for anyone with a long-term focus.
And listen, if there's one thing you take away today for your own peace of mind, let it be this. Despite all the slowing growth and the constant chatter about a downturn, the current data does not suggest a recession is on the horizon for at least the next year and a half.
So let's just boil it all down. What's the bottom line? The economy is normalizing, not collapsing. Slower growth is a normal part of the cycle. Households, for the most part, are financially sound. And those upcoming rate cuts should provide some relief. For us as investors, this means a cautious, selective approach can still unlock some significant value.
And that really leaves us with this final thought. The market is clearly shifting. The era of those aggressive rate hikes is over, and a new phase is beginning. So the big question for you to think about now is, with all these changes happening, where are you going to find your next opportunity for growth?